Bank of Canada's decision is good news for Canada and Canadians, especially for homeowners and businesses. Canada is leading the G7 in achieving a soft landing. Our economic plan is working.
Well, some Canadians are getting another break on some of their bills. Today, the Bank of Canada cut interest rates by 50 basis points, taking the benchmark down to 3.25%. That's the fifth straight decrease, and the bank says there could be more cuts to come. But there is a new and huge asterisk on the bank's outlook. President-elect Donald Trump. The central bank governor, Tiff Macklem, says Trump's threat of a 25% tariff would be, quote, very disruptive to both economies.
No one knows how this will play out in the months ahead, whether tariffs will be imposed, what exemptions get agreed, or whether retaliatory measures will be taken. This is a major new uncertainty.
Frances Donald is the chief economist with RBC, and she joins me now. Frances Donald, it's good to see you again. Thanks for being here.
Thanks for having me.
So we've seen growth projections going down. On Friday, we saw unemployment go up to 6.8% in the country. Is that what forced the bank's hand here today?
Oh, the Bank of Canada has a lot of reasons to have cut by a pretty large 50 basis points and to continue to cut. The labor market is soft, as we heard from Governor Macklem today. That unemployment rate is probably going to keep climbing, and there are downside risks on inflation as the economy continues to decline. And of course, there are a lot of longer, broader threats on this economy, including the potential for a trade war and tariffs coming through, and a change in immigration policy, which is going to, at least mechanically, slow growth as well. So a lot of reasons for the Bank of Canada to feel confident that they should continue cutting rates. However, probably most of the hard work is done. Those rate cuts are probably going to come maybe a little less frequency and a little bit smaller size, maybe 25 basis points instead of 50 going forward.
Okay, so continue to cut. You don't think the Bank of Canada's job is done, even though inflation is sort of back at the target range? It's more about not, I guess, being so restrictive, economic activity is damaged, right?
Well, the Bank of Canada told us inflation is at 2% and we want to keep it there. And with an economy that's slowing, that means easing just a little bit more. The Bank of Canada was pretty clear today. They see more room for cuts ahead. They just used the word gradual. Gradual meaning maybe a slower frequency, maybe smaller 25 basis point cuts. But there is no evidence in their forecasts, in the way they're communicating, or even in private sector forecasts like ours, that the Bank of Canada's job is done quite yet.
We have seen some analysis, though, from people like Derek Holt at Scotiabank, who said these have been too big, too fast, and this could possibly cause inflation to make a bit of a comeback. What are your thoughts on those concerns?
There are always two-sided risks, and what'll matter is what that inflation looks like and what are the drivers of inflation. Are the drivers of inflation ahead, if it materializes, coming from you and I and Canadians spending too much, the labor market being too hot, or are they coming from factors the Bank of Canada cannot control, like tariffs or increased frequency and severity of weather or protectionist policies or geopolitical risks? The Bank of Canada isn't just going to be looking at the inflation print itself, which of course could rise, could fall, will be bumpy, but if it's inflation that rate hikes or rate cuts can cure as well. I think that the distinction is just as important as the forecast at this point.
Talk a little bit about the immigration issue, because we don't know what's going to happen with tariffs, so that threat is hanging there like this sort of Damocles over the Canadian economy. We do know that the number of non-permanent residents coming into Canada is going to be cut quite dramatically. That's rippling through the post-secondary sector. It's going to affect rental markets, for example. A lot of the growth we've seen in Canada has largely been driven by population growth rather than, underlying productivity surges. What are your concerns there in terms of how that could affect things? Because I don't know if we know exactly what kind of an outcome that will lead to.
Well, one of the defining features of the Canadian economy in the last 2 years is that it didn't, on the surface, head into a recession. We didn't get 2 quarters of negative GDP, and that's because the pie was getting bigger as we added more folks to it. But GDP per capita, or the amount of growth per person, has been shrinking. It's been falling for 6 quarters. Now, as we cut the amount of people coming in, if those policies are actually successful and that's the outcome of them, we may actually see the reverse, which is the pie will get smaller, but it's possible possible that the amount that each Canadian has of that pie may actually grow. So this is actually having a huge mechanical inputs or mechanical implications for a lot of our data. But I think the core story is, what are the underlying trends? That is going to be more important for policymakers and should matter more to Canadians than maybe this historically emphasized data point GDP, which we know is being substantially distorted. So it'll matter for certain sectors, certain provinces quite a bit. But let's focus on the story, which is that there's excess in this economy. There are not enough jobs for folks who are coming in. That story is going to persist through 2025, even as the data seems a little bit less clear in the couple months.
Right. What about the dollar, Francis? I wonder what your thoughts are there. It's around 71 cents. There's a lot of reasons why the dollar fluctuates up and down, but it's largely been in a lower phase. How do interest rates, how does monetary policy affect that? Is that something Tiff Macklem should take into consideration?
Well, we always have to take the Canadian dollar into consideration because it matters for Canadians. It matters for how much exports we send out of our country, and it also matters for the price that we pay for things at home. Canadians import a lot of their food, machinery, and equipment. So sometimes a weaker Canadian dollar can actually increase inflation as well. That'll matter to the Bank of Canada. But the good news is that the Canadian dollar doesn't just change based off of day-to-day changes in the Bank of Canada. It's not as though the Canadian dollar tanked today because the Bank of Canada cut 50 basis points. The Canadian dollar cares about what the market has already input as the most likely forecast for the next 2 to 5 years. So the run-up that we've already seen, or the weakness we've already seen in the Canadian dollar, takes into account the divergences between the two interest rates already. So a lot more Canadian weakness, or Canadian dollar weakness ahead is not what I see, but a sticky weak Canadian dollar is probably something that we should all internalize, even if it makes heading down south just a little more uncomfortable.
Okay, so since the rates have started to come down, this is the second half-point cut we've seen. Seen some rebound in consumer spending. We've seen some rebound in the housing market, things that are really acutely sensitive to high interest rates. And so we got the cut today from Tiff Macklem. We're going to get a fall economic statement from Chrystia Freeland at long last on Monday. There's a lot of economic headwinds there, despite some improvement in those sectors. The fiscal guardrails, with the $40 billion deficit, the declining debt to GDP over time, and deficits below 1%. What is your sense of the government's ability to stick to those, or at least stick close to those, given the circumstances they're facing?
Well, lower growth forecasts, of course, make that more difficult, but lower interest rates also make it less difficult. So we'll have to see how those two offset. The really problematic element of doing any sort of forecasting, whether you're the federal government, a provincial one, a private sector economist, or the Bank of Canada, is just how much uncertainty we have ahead. We know those lower interest rates, as you mentioned, will probably help growth a lot more in the second half of 2025. But if we have tariffs imposed upon us, it is a serious economic shock. So what we say, the tails on the forecast, very, very fat right now. And so you're operating, if you're making any sort of choices about Canada, with a huge amount of uncertainty. We also know that uncertainty weighs on business investment. So businesses are less likely to make large decisions until they have more clarity on what the future looks like. Hopefully we get a little bit more clarity from the government on Monday. We continue to see a Bank of Canada that says, no matter what, we're still going to be cutting interest rates. We just don't know the frequency or size of them yet. So there's some things we can rely on, but there are a lot more things right now heading into 2025 that we cannot know as much for certain.
No, look, if the tariffs come, all bets are off, right? I mean, a fall economic statement is not going to do anything to offset what we're going to see if Donald Trump makes good on his threats. But just a last question, Francis, about the deficit. Like $40 billion, round numbers, is what the expectation has been. That's what they projected on budget day. All indications are it's going to be a fair bit higher than that, at least in nominal terms. How big does the deficit need to go before Canadians should get really worried? Because like $40 billion is a lot of money, but on an economy this size, it is a small percentage. What is sort of the number that we could see where you'd say, okay, this is a red siren going off?
It is actually not about a number, in my opinion, David. It's about what that is being spent on.
Right.
If we see, this is true for any economy in any situation, money that is spent on supply side developments, building houses, infrastructure, things that help productivity and help the economy grow over the long term, is going to be treated very, very differently by markets, by credit agencies, than if we see, for example, demand side measures, a lot of checks being sent out that tend to do little for growth but boost inflation. So our eyes, yes, we're going to be watching the deficit. We need to make sure we remain fiscally responsible. Lots of challenges ahead, is on the what, not the final amount.
Okay, so if it's empty calories, you're going to be upset, but if it's robust development, then it's justified spending, is more or less what it sounds like.
An evergreen statement from an economist that I will bring back to this show time and time again.
Okay, well, Frances Donald, you're welcome to come back time and time again. That's Frances Donald, the chief economist with RBC. Thanks for being here today.
Thanks for having me.